Thank you very much. Good morning, everyone. Thank you for inviting me to speak to you today, and my speech will be available on ASIC's website in the next few days if you actually want to verify what I've said. Look, it's very exciting to hear from the regulator, isn't it? As I say to our crop of new graduates every year, you better get used to it. It's a good day as a regulator. You know it's a good day if you've managed to make everyone that you deal with equally unhappy. It's tremendously motivating. That gets you out of bed in the morning. I once said that a year or two ago at a conference, and there was an American academic there who said, no, that's too static. You need a more dynamic description of what a regulator does. And the regulator's job is to disappoint people at a sustainable rate. You've been warned. Okay. Look, as you know, your industry is the subject of significant public scrutiny at the moment, but so is the entire financial services sector, and I think that's part of the context here. There's a high degree of focus on the home mortgage market, on the financial advice market, on the insurance sector, on accountants, banks, the superannuation sector. The government's just announced a review that the Productivity Commission will be undertaking into competition across the entire financial services regime, and that will range from the retail markets through to the wholesale markets, infrastructure and so on. So it's very clear that customer expectations are changing, the political expectations are changing, that people are looking for better outcomes and to ensure that there are robust standards. They're also, and this is a clear message coming from David Murray's inquiry a few years ago, there's also a clear expectation that the days where you would wait for the problem to emerge, you would wait for the bodies to fall off the cliff and be lying there at the bottom before you'd act to clean them up, that those days are gone, that there is an expectation that there will be a more proactive approach to ensuring that markets deliver the sorts of outcomes that we all want to see. So that's, I think, a key part of the context that you need to understand in terms of the review of your industry. It is an opportunity. It's much better to be the subject of scrutiny before some sort of significant problem emerges, where you can have a discussion outside of that sort of context, rather than be doing it in response to some sort of disaster. So you ought to, as David said, take the opportunity to embrace this and look at ways that you can improve how you deliver good outcomes for consumers. So we're keen at ASIC to work with all of the participants in this broad sector to grapple with some of the issues that are in front of us. And so that's why I welcome the opportunity to be here this morning. So I'm going to focus on our report, and I'm going to touch on five issues in relation to that report. Consumer outcomes and competition in the mortgage broking industry, our findings, some indicators of what the industry can do now to ensure that you meet key legal requirements going forward. I also want to briefly touch on some of the proposed reforms to the Ombudsman scheme, not issues that we dealt with in our report, but I want to touch on them briefly, and finally a few comments on culture as I finish. So, yes, ASIC acknowledged up front in the report that brokers can and do play an important role in promoting good consumer outcomes and competition in the home loan market, and we stated that in our report. Brokers are responsible for arranging around 54% of home loans in Australia. That's up from around 47.7% in 2012. And from a perspective of better consumer outcomes, in a well-performing market, brokers can help to match the needs of the consumer with the right product and lender. You help the consumers navigate the home loan application process, which can be daunting for some consumers. And you, I think, can play an important role in improving consumer understanding of home loans and that sort of financial literacy element. From a competition perspective, brokers have the potential to play a valuable role in providing a distribution channel for different lenders, and that's particularly important for, I think, some of the smaller lenders who don't have the same sort of branch network or direct network that some of our larger lenders have. Brokers also have the potential to exert downward pressure on home loan pricing by forcing lenders to compete more strongly. So you have a very important role to play. You wouldn't be the subject of a review like this unless you had an important role in this sector. But like other markets, in particular like other markets where you have a significant intermediary presence, such as investment or insurance markets with financial advisors, there's no sort of guarantee or natural law that says these positive outcomes are going to emerge. You have to work at it over time. You have to make sure that you're checking how the market works in practice. And one of the major factors that will determine whether you do see these good outcomes or whether you see outcomes that are not so good is the way in which the remuneration drives behaviour. So do remuneration practices create incentives that are aligned with the interests of consumers, or is there misalignment? And I hardly need to explain to this audience that you only have to look around the world what happened during the GFC, that where there was significant misalignment between the interests of the people selling or designing or distributing financial products and the consumers and end users that were buying them, you had problems. Similarly, do ownership structures influence outcomes in ways that are beneficial or less beneficial? Is there anything we need to check on in relation to that issue? So in the work we did for this report, we looked at these sorts of issues. We considered that some elements of the current remuneration and ownership structures might be inhibiting the achievement of better outcomes, and that these were things that ought to be discussed and considered by all stakeholders. So commencing in 2016, we conducted the review. It was at the request of the government. Minister Kelly O'Dwyer said that she wanted ASIC to undertake a review to, and I quote, determine the effect of current remuneration structures on the quality of consumer outcomes. And as you know, that we released the report in March this year and made a number of findings and proposals. It was a very large exercise. We engaged with a whole lot of people, obtained information from 19 lenders, 14 aggregators. We spoke with 44 broker businesses, a mixture of small, medium and large. There may be some of you in the room today that were part of that. If so, thank you. We really valued that input. We gathered and analysed around 4 years' worth of home loan data. It was a very big exercise, very much a data-driven project. And I think that has provided a powerful evidence base for a discussion about the best regulatory framework going forward. We set out 13 findings in our report. Some of those relate specifically to the broker channel. Others relate to the market as a whole, that is, loans sold through both broker and non-broker channels. At 243 pages, yes, it's a longish report. I'm sure many of you have committed it to memory already, but if you haven't done so, the executive summary is 22 pages, slightly more digestible piece, and I would seriously encourage you to have a look at it. So I'd like to just quickly run through the findings from the report now. And in some ways, our first, or the starting point for the report was a snapshot, if you like, of the remuneration structures. You will, of course, be familiar with many of these. The first finding, the first clear finding and obvious starting point was what we call the standard commission model, which is almost universal and is made of an upfront and trail commission. But while this was common across lenders, we did find significant variability and complexity in the detail of the structures. And that was the case both for the ways in which the commission was calculated and also the rates at which it was being paid. Now, this next point I'm going to make is one where I think there's been some misunderstanding in the sector. As we said in the report, commission arrangements create a conflict of interest between the broker's interest and the consumer's interest. But I want to make it clear that that's not to suggest that commission structures automatically result in poor consumer outcomes. There are conflicts of interest in all areas of life, in all industries that we deal with. I have to provide a 6-monthly statement of the conflict of my financial holdings to the Minister because I regulate the finance sector, but I also have insurance policies, home loans and a super fund and whatnot. So the question is not do conflicts of interest automatically lead to poor outcomes, but rather where do they exist, what do they look like, how are they being managed, can we make sure that they're not leading to the wrong sort of outcomes? So that is the context in which we look at this issue. And in our view, these conflicts in this area can manifest themselves in two ways. What we call the product strategy conflict, where a broker may recommend a particular product or strategy to maximise the amount that the consumer can borrow, and that conflict exists because commissions are linked to the size of the loan. And the second is a lender choice conflict, where a broker could be incentivised to recommend a loan from a particular lender because the broker will receive a higher commission rate from one lender versus another. Again, I want to emphasise that these issues are not unique to this sector. It's better to name them, be upfront about them, and talk about how you're going to make sure that they can either be minimised or dealt with in such a way that consumers still get the right sort of outcome. The second issue that we looked at was bonus commissions. So in addition to the standard commission models, aggregators receive bonus commissions from lenders, which can be passed on to brokers. Importantly, lenders' staff, the direct channel, also receive bonus payments, which can be very, very significant in some cases, and which also obviously give a rise to potential conflicts of interest. And the two main types that we identified there are volume-based and campaign-based commissions. We recognise that some of these, particularly volume-based payments, are not always passed on to brokers and may be retained in full by the aggregator. The third issue in the remuneration structure that we described was soft dollar benefits, which are widely used in the broker channel. And the main types being loyalty programs like broker clubs and travel or hospitality related benefits, including travel to overseas conferences. Those benefits, particularly broker clubs, were more often offered by the larger lenders and appeared to be associated with a high proportion of loans being sent to those lenders by members of the relevant broker club. The fourth point that we identified, and this is an important one, is that there is a difference in the characteristics of consumers going through a broker versus consumers going directly to lenders. We pass no value judgment on that issue, but it's important to understand, because if you don't take that into account, you are not necessarily going to be comparing apples with apples when you look at the outcomes that you get through the broker channel compared to the direct channel. So we control, typically consumers going through a broker tend to be younger, tend to be on lower incomes. So we controlled for those differences in looking at our results, And as a result, I think we were able to get a better understanding of the genuine differences in consumer outcomes between the broker and non-broker channels. So that's a very quick description of the remuneration structure, which, as I said, we divided into 3 levels, and the consumer characteristics. So we made a number of observations about broker loans compared to non-broker loans. Firstly, we found that loans obtained through brokers tend to be larger in dollar terms, with higher loan to valuation ratios, and are more likely to be interest-only loans. In making that finding, we're not passing any particular judgment on it. We're certainly not suggesting that that indicates that brokers are not meeting their legal obligations under the responsible lending laws, but rather there is this difference. It's important to identify it, and I think industry and ASIC need to do some more work to understand the reasons behind these differences, and are there any issues that we need to grapple with there. And we'll be undertaking some further work in this space, including potentially a shadow shop exercise. Second issue is around interest rates. Interestingly, we found that within lenders, there was little difference between the interest rates that broker loans receive compared to non-broker loans. Now, of course, this won't reflect the work that a broker may undertake to identify the better rates between lenders, but it is an interesting finding from our perspective. Based on raw numbers, the next finding, loans provided through brokers were more likely to go into arrears than loans provided directly by the lender. Although this is a good example of the demonstration of being able to, or a good demonstration of why it's important to control for the difference in consumer characteristics, because once you do that, those differences in default rates certainly dropped, and in some cases, for some lenders, disappeared altogether. But the difference is still there, and it's important to understand. We found, and this is a message for the entire industry, not just the broker channel, we found evidence that both brokers and lenders' own staff were not making sufficient inquiries into consumers' expenses. And we saw this through the fact that lenders reported that the disclosed expense amount was identical to the benchmark figure for a high proportion of loans. Now, we recognise that in more recent times there's been a lot of discussion in the industry about improving practices in this area. That won't necessarily be reflected in our findings, but that, I think, is a message for everyone, not just for you in this room. And we also made some observations regarding competition in the market. We looked at whether the existence of an ownership relationship between a lender and an aggregator impacted the flow of loans. And overall, there was some indication that competition in the home loan market is affected by ownership relationships between lenders and aggregators, particularly when combined with a white label relationship. And we found indications that smaller lenders may be at some disadvantage in the market as they do not have access to the same number of brokers as larger lenders. And they also typically don't have the same ability to pay bonus commissions and provide soft dollar benefits in the way of in the same way as some of the larger lenders. I'll touch on three other findings just very quickly. One is that we found that too often the governance arrangements could be improved to better take account of the issue of what sort of outcomes are you delivering for consumers. We found they don't focus sufficiently on making sure that there is oversight of the conduct of brokers or lenders staffed in dealing directly with consumers, or on the quality of consumer outcomes. Now, if you look right across the financial services sector, not just in this area, there is a focus on governance. There is a focus on having people at the top of the organisation making sure it cascades down that everyone has that sort of focus. You shouldn't expect anything different in this sector. We found there's room for improvement there. Another finding that we are focusing on relates to so-called referrers. We found that mortgage referrers are being paid almost as much as brokers, despite referrers playing a more limited role, and despite the fact that in many cases they don't meet some or all of the standards that brokers must meet. And that frankly, was a cause for concern. We are talking to lenders about how they have used so-called referrers and how that might improve into the future. And finally, I'll just mention that we had a lot of challenges actually getting the right sort of data from lenders and other participants. One of the things that frankly surprised us a bit was that lenders, including some of the largest lenders that have the most money to invest in their systems, really did not have a good line of sight on who their loans were being distributed through and how and that sort of thing. So that's something that we're looking at further, including, as I'll mention in a moment, the potential for some public reporting on outcomes. So we made a number of proposals which are now out there for consultation. You've still got an opportunity to provide input on this, and you've heard from David that is something that AFG and the industry associations are doing. These things are up for debate. That was the purpose of the report. So firstly, we said that the standard commission model should be improved. We didn't suggest that it should be in any way abolished, but we thought there might be scope for ensuring, in particular, that it was not based purely on loan size. Second is that we said the industry should look at moving away and better managing forms of remuneration that give rise to higher risks of conflicts. And by this I mean sort of volume-based conflicts and campaign-based commissions. And the third proposal was a similar one about moving away from soft dollar payments, which are widespread. I mean, frankly, you only have to look at how soft dollars are now regarded in other industry sectors. So these not only can cause poor consumer outcomes, but as we found, they place smaller lenders at a disadvantage in terms of competition because typically they're not as well placed to provide those sorts of benefits. We thought that improvements could be made to ensure much clearer disclosure of ownership structures, and that includes in marketing material and at distribution points, so that consumers know who they're dealing with when they go to deal with a broker or source a loan. We also indicated that a public reporting regime to help consumers make better decisions, but also to help you be better informed, would be of benefit. This goes to things like the average pricing of home loans provided by lenders across different distribution channels and so on. And finally, as I said, there's a need to improve governance. So we suggested that these proposals could be implemented before a further review is conducted several years down the track. I don't think it's something where we'd want to say, gee, we need another review next year or the year after that. We're talking give some time for these things to be debated, for the industry itself to have the opportunity to say, well, we think these things we can deal with ourselves through our own forms of self-regulation. Maybe there are other things that require some sort of government regulation. Those are now up for debate, and Treasury has invited all interested parties to make submissions by the end of this month. So that's where it's at. We are continuing to have dialogue with the people in your sector. We're continuing to get feedback. We're continuing to have debate. That's the nature of it. And as I said, it's a much better time to be doing this and to be having these discussions now than if there was some problem down the track. I'll just very briefly mention that we're obviously aware of the parallel discussion of some of these issues under the ABA initiated review completed by Stephen Sedgwick. I'm not going to go into details about the Sedgwick review. Our short point is to emphasise that any changes that are considered for remuneration structures should have as at their core, how is this going to contribute to better consumer outcomes? This is not about favouring one, in our view, one particular institutional or structural participant over another. You've got to keep the end consumer in mind. And as I said earlier, a sustainable and well-operating mortgage broking sector is very important for good consumer outcomes. So delivering on this objective will require all stakeholders to work together. Quickly, what lies ahead for the market? What can brokers do in the current environment? Well, obviously, it goes without saying, be aware of your obligations under the Credit Act. We've got extensive guidance out there if you haven't already looked at it. We've had a particular focus on responsible lending practices in relation to interest-only loans. And we've highlighted a number of good practices for brokers inquiring into consumer requirements and objectives. Our report on that area highlighted some potential compliance risks and ways in which you can reduce those risks of non-compliance. This includes making sure you understand the consumer's underlying objectives for requesting specific loan products and features. Documentation, I mean, it's just still a surprise about how often that is the source of problems. Provide a statement summarising your understanding of the consumer's requirements and objectives. It shouldn't be that difficult. In cases where consumers pursue a strategy with a particular benefit in mind, make sure you know what steps they must take to receive that. For example, they must tell you as a broker when their financial circumstances change and they can start, for example, to pay principal and interest on a strategic interest-only loan. So we would encourage you in the industry to review any practices that may not align with good consumer outcomes. We're going to be doing further work in this area, targeted industry surveillance this year, to examine the practices of lenders and mortgage brokers, everyone in the sector, when it comes to recommending interest-only loans, particularly with the pricing differential that's now there. And we want to actively engage with industry on how to make sure we get the right sorts of outcomes. As I said, I just wanted to also briefly mention today the review of the Ombudsman scheme. Hopefully, none of you will ever have to deal with the Ombudsman scheme. But it's an important part of the regulatory landscape, and it really does help consumers right across the board. It obviously exists for all participants right across the financial services sector, and it's recently been reviewed by a panel under the leadership of Professor Ian Ramsey, and he recommended the creation of a single scheme and a range of other issues which ASIC supports. But I just wanted to touch on one issue. His report also recommended that in principle there is no reason why individual credit representatives should continue to pay to hold Ombudsman membership, given that credit licensees have to be members of an approved Ombudsman scheme. And such a change would mean that the external dispute resolution membership, the EDR membership requirements on credit representatives would be consistent with, for example, financial advisors who are not required to hold individual membership because their licensee is a member of the EDR schemes. And the review found that there was little benefit that could be identified through this individual membership requirement. So we support the recommendations in the Ramsey review. The government has supported them. They announced that in the May budget. It's an example of where regulation has to be at the right level. ASIC supports increased regulation where it is needed, but we also think it is important to identify and remove regulatory requirements that aren't necessarily serving a need, and I think that's one that you ought to consider. So just to conclude, in some ways, this is all about the debate we're having right across the financial services sector and in your industry comes down to that sort of interesting concept of making sure you've got the right culture. Is it a culture that focuses on better consumer outcomes? Is it a culture that's ultimately going to be driven by the right sort of competition? A good culture is beneficial not only to consumers but to the industry as a whole, to lenders, to aggregators, to brokers. And I want to take the opportunity to reiterate that better market outcomes can be achieved by making sure you've got the right culture, and that sort of good conduct, that sort of work that you do as brokers can lead to very good outcomes to consumers, and that's really where we want to land with this review. I've used a broker. I've had a very good experience there, and I think it's something that we want to make sure continues to occur and happens right across the sector and isn't undermined by the wrong sorts of structures. We will be incorporating culture into our current and upcoming work. The regulatory environment and reform agenda that is on foot at the moment is really, I think, in some ways compelling industry to ensure that you think about how you put consumer outcomes at the forefront of your mind, and that you make sure that you don't end up in the situation of some of the other industries that have been talked about. Thanks very much for inviting me here today. Thanks for the opportunity to talk to you, and I wish you well for the remainder of your conference.